Welcome back to Market Masters. After some relentless sell-off in global and Indian IT stocks, we are seeing some respite with IT companies like Infosys saying that they actually see an opportunity of, 300 to 400 billion dollars in helping legacy systems, legacy companies adapt to and use AI. So, are IT companies bottoming out? Are they good to be bought again? Joining me now is the Managing Director and Head of EM Equity Strategy at Goldman Sachs, Sunil Koul. Sunil, thank you very much indeed for joining us. Well, that really is the first question. The big crash of IT stocks we saw in India and some respite over the last couple of days, with this very strong argument coming from Nandan Nilekani and Salil Parekh of Infosys that there is an opportunity gap. It all depends on how we execute. Do you buy that?
Sure, Latha. First of all, a pleasure to be back on the show.
Thank you.
Listen, I think you're right. If you look at what has happened in the market in the last few weeks, I think there has been a relentless selling and indiscriminate selling of the software companies because global investors are basically questioning the terminal value of these companies. And as we know, software adoption at the enterprise level is pretty complex, right? There are winners and losers and different cohorts, and somebody has to provide the cleaner data sets for these AI models to work. Somebody has to drive the enterprise adoption, as we were just discussing. And so there would be companies that will benefit from that, including software companies. But I think in the US market, the real issue is not just the terminal value, but the margins for these companies are also at record highs. And so in the next few quarters, until we figure out who is kind of winning, how the business modes are, what the pricing power for these different sectors are, probably there are still going to be uncertainties around this. And so we are not advising clients to buy into the global software companies yet. I think having said that, if you look at the Indian software companies, obviously they have also been under pressure, down 15% or so over the last month or so. Over the past year, given the selling we have seen in Indian equity markets, software companies are down 30%. So we are not expecting absolute sort of large downside from current levels. And in that sense, you can say maybe the stock prices are bottoming out. And given the news flow in terms of Anthropic's announcement on one of the large IT companies driving adoption, I think that's a welcome sign. And maybe that sets a floor on the stock prices for the sector overall. But our general sense is that, look, the Indian software companies, when you look at it from a relative perspective, they are still a bit more expensive than the global peers. And if anything, that valuation gap has widened because the global peers corrected more than what the Indian software companies recently have corrected, right? And so relative returns, they may still be underperformers. And when we look at the Indian equity market relative to other sectors, we still think some of the domestic pockets are much more compelling. So we're still underweight the broader sector on a relative sense, but I think agree with you that the absolute stock prices might find a bottom, especially given the recent announcement on that.
Okay. Well, I just wanted to start with IT companies because it's so much top of the mind. But let me zoom out. The third quarter results are out in India. And what has that given you in terms of earnings growth indications? And what are the good sectors right now?
Yeah, look, I think as you may sort of recall, Latha, we turned positive on India back in November, so yes, a couple of months back, taking it back to overweight within our broader Asia and EM allocations. And that was after being cautious for more than a year. And so I think the main sort of core view there was that we were expecting all the policy easing both from the RBI and the central government to show up in the numbers and drive earnings recovery. In terms of what we are seeing in the December quarter, I would say, look, I think numbers are moving in the right direction. MSCI India, which is what we sort of track, the profits there were up 11% year on year. The expectation was about sort of 8%, so 3 percentage points ahead of that number. But more encouragingly, I think it was the top line that has been driving the growth as opposed to margins. That has been the case for past many quarters. And so the revenue growth was at 9%, which is at a 3-year high. And that obviously that's kind of backward-looking data, but in terms of the forward-looking sort of guidance and indicators also, whether you look at the credit growth numbers, you look at the auto sales numbers, you look at some of the commentaries from defense companies, the consumption companies, we are getting more and more hopeful that the earnings recovery is coming through, and we are anticipating earnings growth to go back to sort of mid-teen earnings for MSCI India, which is what our Nifty or broader market return expectations are 29,300 on Nifty, which is roughly that mid-teen return expectation. So we are not baking in any multiple expansion from current levels, even though multiples have derated from peak levels. But we think just as underlying earnings come through, market should do much better over the next 12 months.
Well, that has been my reading as well when I look at, as you say, credit growth, SBI's guidance, very strong. As well, as you say, auto sales, some of the food FMCGs posting double-digit revenue, double-digit volume after a very long time. But what are your pockets? Would it be consumption or would it be financials?
I think both of those things. We have been overweight financials, as we were discussing. Credit growth is picking up. RBI has done a bunch of easing measures. Some of that is still yet to come through this year and next, and we think that will cumulatively release about 2 percentage point of non-food credit into the system, and we are expecting credit growth to continue to improve, and therefore, balance sheets, as we all know, for the banks is still very strong, and we think profitability can be sort of 15% plus for the banking sector over the next couple of years. So banks is one of the overweight sectors. We still continue to like the consumption cohorts. We have been overweight autos, still like that pack, and as we just discussed, we are seeing recovery across the different sort of pockets in the auto segment. We have been overweight staples as well, both volume recovering and margin tailwinds from some of the input costs there. And so I think consumption plus financials are where we are expecting the leaders of this recovery. And we are, as I said, we are seeing more and more signs of both urban and rural pockets improving. Out of the broader industrial capex sensitive sectors, I would say we still like defense. The current reporting season still shows that some of those names are printing very strong earnings growth, and that's obviously a broader thematic pocket we like across the region, given the geopolitics. Power is obviously a theme as well that is gaining from the strong power demand everywhere. And so, barring a few capex pockets, I would say financials, consumption, and then defense power is where our most overweights are.
Okay, let me just quickly ask you about metals. We did see fairly strong earnings from the steel companies and, of course, the non-ferrous even more, but they've quietly sold off.
Yeah, look, I think metals pack, we're kind of more neutral that camp, just because we do expect metal and precious metals to be sort of having a strong momentum relative to the oil, but it does feel like some of the rally in metals was more sort of technical driven because of sort of tariff issues, because of hoarding in US, and so there was an artificial scarcity in the metal markets in London and elsewhere outside of the US, and so some of the price appreciation we saw in the metal prices was more sort of technical in nature, and I think it's not. And near term that momentum could extend, but our sense is that as we go sort of to 6 to 12 months at the back half of the year, you should see some of those metal prices come back in, which is why we are not sort of as bullish on the metal complex relative to domestic.
Fair enough. But, even after the announcement of the Indo-US deal, even if the final signing is due, the punishing 25% tariffs are off, we haven't seen foreign funds return. There was a bit of positive buying, but then again, punctuated with big sells. What's holding foreign funds back? Is it the rupee?
Not necessarily. Look, I think I'll come to the flows in a bit, but just to tackle the question on rupee, I would say, look, I think the weakness we saw in rupee earlier this year and in the fourth quarter of last year, to us, I think that was sort of a policy choice, right? Obviously, you know that as well, but the starting point of rupee was overvalued. You had weak equity flows. You had the balance of payment, which was worsening a little bit because of the gold prices and imports there, and trade uncertainties were still lingering, which means it makes sense to have a little bit weaker currency. I mean, where we are now, we think the peak underperformance is behind us. And we'll come to the capital flows, but certainly from over the last 2-3 weeks, we have started to see capital flows improving.
Fair
We
enough.
also think that the exports should get a boost with the removal of the with the coming of the trade deal. The lower tariffs or the removal of tariffs on Russian oil should also help. And I think all of that means that your current account going forward should look better than what it was previously. And we have actually raised or improved our current account numbers a tad for the rest of the year. And so I think with that backdrop, we do think that, I mean, you may not see a lot of spot appreciation because RBI may still want to sort of keep it more stable. But our sense is that the peak underperformance is behind us. So in that sense, I don't think necessarily that's a big worry for clients in the recent conversations. What I can tell you, and I mentioned this to Prashant as well a couple of weeks back on the show, is that there has been a noticeable pickup in client interest, especially in Europe and US. After the trade deal, and I think many of these clients viewed this as a major overhang for the Indian equity markets, and so interest levels have clearly picked up. We see that a bit in the flows, we see that in the conversations. I mean, for what it's worth, at least since the trade deal was announced, we have seen cumulatively 2 billion of foreign inflows in the market, relative to sort of 30 billion of the selling from the peak September 2024, right? So I think directionally that's better. What's also important to keep in mind is that if you look at the broader emerging markets, we are seeing very strong inflows in EM equities as a pack, not just sort of passive, but also in active funds. And those trends are really accelerating. In fact, I think year to date, emerging market funds, the GEM funds have seen close to 40 billion US dollars of inflows, which is the strongest pace of inflows that we have seen in EM in the last 2 decades. And so in terms of narratives, in terms of flows, I think the sentiment around EM has been very positive coming into the year, and some of that money will obviously trickle into Indian equities as well. So there is a broader sort of positive backdrop for EM that will be helping India, in addition to India's kind of idiosyncratic drivers in terms of recovery that should be helpful. And I think the last thing I would say is that given all the tech volatility we are seeing, what we discussed at the top of the call, I think at the margin, people are also realizing that it makes sense to diversify a little bit away from sort of tech-heavy markets to more domestic pockets, and Indian equities is one of the best diversifier in that context, right? And so I think if you put all those three things together, our sense is that looking forward, foreign flow should improve into the Indian equity market.
Oh, Sunil, that's the most cohesive, comprehensive, convincing argument that perhaps the bleakness that we saw in the equity markets earlier in February is perhaps behind us. Thank you very much for joining us with your sense of where EM funds are headed and what you like in the Indian market. Okay, well, that's it on this edition of Market Masters and this edition of Bazaar. Thanks so much for watching. Chartbusters coming up after a break.